Most ultra-rich individuals pay a lower effective tax rate than their own employees do. This is why rich people structure income differently. They understand income comes in many forms, not just a weekly paycheck. A salary or wage is active income. It requires your time and effort. Most people earn 100% of their money this way, but wealthy individuals usually shift to passive income sources. They create streams that make money even when they are not actively working. This could be from investments or businesses they do not directly operate every day. Think about it. An employee might pay 37% of their ordinary income in federal taxes, but a top investor could pay only 20% unqualified long-term capital gains. That is a 15% difference just in how the money is taxed. Many rich people build businesses not just for direct profit, but for the structure they might establish an S corporation. This allows them to pay themselves a reasonable salary and then take the remaining profits as distributions. This strategy can save thousands of dollars each year on self-employment taxes, which normally add up to 15.3% on earnings up to $168,600 in 2024. An LLC, or limited liability. Company is another common choice. It separates personal assets from business debts. If the business faces a lawsuit, a personal home worth millions remains protected. Without such a structure, a single bad deal could wipe out a family's entire net worth built over decades. Real estate is a massive component of wealth building for the rich. 90% of millionaires own real estate. They do not just buy one home. They acquire many income-producing properties. A typical strategy involves purchasing 5 to 10 rental units. These properties generate monthly rental income, often $2,500 per unit, but the real magic lies in tax benefits. Depreciation is a non-cash expense that reduces taxable income. For instance, a $500,000 property might depreciate by $20,000 a year on paper. This means they pay taxes on less income even if the property is cash flowing. And they can use a 103-1 exchange to defer capital gains taxes when selling one investment property to buy another. This deferral can continue indefinitely, potentially for generations. Imagine deferring taxes on a $5 million gain for 50 years. That is a substantial amount of money staying in their pockets and continuing to grow. Another key difference is leverage. Most people see debt as bad. Rich people see good debt as a tool. They might borrow $400,000 at a 6% interest rate to buy a $500,000 asset. The asset appreciates at 8% a year and generates rental income. They use the bank's money to make their own money. This amplifies returns. If they put down $100,000 and the property value increases by 8%, or $40,000, they have earned a 40% return on their initial investment, not just 8%. And the interest paid on the loan is often tax deductible, further reducing their tax burden. Investment diversification is critical. The average American might have 1 or 2 investment accounts, maybe a 401k and a Roth IRA. The rich have dozens of accounts and vehicles. They invest in private equity, venture capital, hedge funds, commodities, art, and even fine wine. They spread their risk across many asset classes. This means if one sector, like tech stocks, takes a hit, another, like gold or real estate, might perform well. They might have 5% of their portfolio in precious metals as a hedge against inflation and currency devaluation. They understand inflation running at 3% a year can erode wealth over time, so they seek assets that historically outpace inflation. Trusts are fundamental for asset protection and legacy planning. A revocable living trust allows assets to pass to beneficiaries without going through probate, avoiding costly and time-consuming court proceedings. An irrevocable trust offers even stronger asset protection, shielding assets from creditors, lawsuits, and even estate taxes. For someone with a net worth of $50 million, an estate tax of 40% could mean $20 million lost to the government. An irrevocable trust can mitigate or eliminate this. Some trusts are designed to last for hundreds of years, protecting wealth for multiple generations. The wealthy also set up charitable foundations or donor-advised funds. These structures allow them to donate millions to causes they care about while receiving significant tax deductions. They can deduct up to 60% of their adjusted gross income for cash contributions. This reduces their taxable income substantially while doing good. The rich often think in terms of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. Earning 10% on $100,000 gives you $10,000. The next year, you earn 10% on $110,000. Over 20 years, that $100,000 can grow to over $670,000. Most people focus on linear growth. The wealthy understand exponential growth. They reinvest profits consistently. They rarely pull all their money out. They keep it working for them. This mindset alone can create a gulf of hundreds of millions of dollars over a lifetime, compared to someone who spends their earnings. They also employ armies of professionals. A regular person might use H&R Block for tax preparation. A wealthy individual has a team of certified public accountants, financial advisors, estate planners, and corporate lawyers. This team costs tens of thousands or even hundreds of thousands of dollars annually, but these professionals find every legal deduction, every loophole, every tax efficiency. They proactively plan for future tax law changes. This proactive planning saves them millions in taxes and protects their assets from future risks. For example, a skilled tax attorney might help them take advantage of opportunity zone investments, which can defer and reduce capital gains taxes for over a decade. Private placement life insurance is another obscure tool. It combines an investment account with a life insurance policy offering tax-deferred growth and tax-free withdrawals in many cases. For those with a net worth exceeding $10 million, it is a powerful way to grow wealth outside traditional taxable accounts. It is not something you will find advertised on television, and for large businesses, they often use research and development tax credits. These credits can be worth up to 20% of qualified research expenses, directly reducing their tax bill dollar for dollar. A company spending $5 million on R&D could save $1 million in taxes. Their spending habits are also different. While they certainly enjoy luxuries, they often make their assets pay for their lifestyle. For example, a private jet might be owned by a company that leases it back to the owner for business use, allowing for depreciation deductions and expense write-offs. A yacht could be an asset for client meetings or business entertainment. These are not just personal toys. They are structured as business expenses. This is a fundamental shift from consuming wealth to making assets support a lifestyle while simultaneously providing tax advantages. They understand the difference between good debt and bad debt. Good debt, like a mortgage on a rental property or a loan for a growing business, helps acquire income-producing assets. Bad debt, like high-interest credit card debt for consumer goods, depreciates quickly. The average American carries $6,000 in credit card debt. Rich people carry very little consumer debt. Instead, they use debt strategically to amplify returns and acquire more assets. This allows their money to multiply faster. They also understand how to use a grantor retained annuity trust, or GRAT, to pass wealth to heirs with minimal gift or estate tax implications. This can transfer millions of dollars tax efficiently. This is not about magic. It is about understanding tax codes, investment vehicles, and legal structures that the average person never learns about. They are taught to earn a salary, save a little, and invest in a 401k. The wealthy are taught or learn to create businesses, invest in a diverse portfolio, use sophisticated tax strategies, and protect their assets through various trusts. They often have 7 or more income streams, while the average person relies on 1 or 2. This proactive and strategic approach to money and assets is the cornerstone of sustained generational wealth building. It is a game of strategic chess, not checkers. It takes planning, patience, and a deep understanding of financial instruments. Most people spend their lives earning money. The rich spend their lives making their money earn money for them. And that is the profound difference.